Have you ever taken a vacation to someplace sunny and beautiful? No doubt on your way to the beach you probably noticed all the impressive houses along the way. Houses that belong to the locals, the people that are lucky enough to live year-round, where most of us will put ourselves further into debt just to visit. Hello, I'm Jeremy Jameson, and today I want to give you a little bit of information on some basic investment principles, hopefully to help you alleviate some of the intimidation that so many people feel when they begin to think about investment strategies for their future. I have recently begun to educate myself in this topic over the past few years. I've read dozens of books, including The Truth About Money by Rick Edelman and Rich Dad Poor Dad by Robert Kiyosaki. I've established a foundation for my financial future. The few key points I want to share with you today will hopefully help you feel more at ease in money matters and equip you with enough understanding to make your own educated decisions. I'll focus on three main points: stocks and bonds, mutual funds, and retirement accounts. It would be impossible to become an investment tycoon from a 5 to 10 minute speech. But through these 3 points, you'll have a better understanding of some of the tools at your disposal. Let's begin with stocks and bonds. There are thousands of companies out there, some of which are successful, some of which are not successful, some of which are complete failures. You can take part ownership in these companies or grant short or long-term loans to them. Ownership, of course, refers to stocks. Loans will refer to bonds. Let's talk about stocks first. Every publicly traded company is traded on a stock exchange. The two biggest exchanges in the United States is the New York Stock Exchange and the NASDAQ. Stocks are sold by individual shares. Each individual share is a small slice of the company's ownership pie. Stocks are purchased through brokerage accounts with a financial institution. There's a couple advantages to buying stocks. First of which is if the company does well, the demand will rise for that stock. That'll make the stock more valuable. You can sell it at a profit. Another advantage is some companies share their profits. They pay them out to their shareholders 1 to 4 times a year, and this is called dividends. The more shares of the stock you have, the more dividends you're going to get. There's a disadvantage to stocks too, and that's pretty obvious. If the company does poorly, the stocks are going to decrease in value. If a company goes belly up, you could be left holding an empty bag. Now let's talk about bonds. Bonds are very simple. It's a loan. It's a loan from you to the company. If a company needs money, they sell bonds at a specific rate for a specific period of time. The company gets the revenue they need with the intention to repay it later with their profits. You get a return on your investment that's not affected by market factors. A lot of people will use bonds when the market looks like it's going to be turbulent or like we're going to be going into a recession. Both have a direct relationship with you and the company, and both have advantages and disadvantages that are tied to the success of the company. A prosperous company will yield terrific results for an investor. A company that's struggling is going to yield poor results. A company that fails altogether, like I said before, you're going to be holding an empty bag. This is why it's a high-risk, high-reward type of business, investing in stocks and bonds. Next, I'll talk about mutual funds. Everybody here has heard the term mutual funds at one point or another. The term can be mysterious if you have limited financial experience. What if I told you there was a way to invest in stocks and bonds where other people, experts in the field, did all the research and selected the companies for you? What if I also told you that at the same time your money would be pulled together with many other people's money and spread out among a lot of different companies? This is what mutual funds are all about. Investorama terms it an easy way to own stocks without worrying and choosing individual stocks. There are thousands of mutual funds available. Each one is managed by a professional according to that fund's objective. There's a lot of different objectives that a fund could have, anything from preservation of capital to aggressive growth. Many of the same advantages of stocks are shared by mutual funds. Dividends are added up and paid to shareholders at the end of the year, and of course that's going to be proportionate because your fund, each share represents shares of hundreds of companies. Also at the end of the year, capital gains are added up from the profits from selling individual stocks within your mutual fund. There's an additional advantage of mutual funds that comes from, or in the form of security through diversification. Due to the fact that you have shares in many companies, if one company fails, it's not going to ruin your total investment. There's one primary disadvantage to a mutual fund. That is the removal of the home run threat. If you're not invested all your money in one company, then you remove the chance that that company could grow exponentially, thus your money growing exponentially. Mutual funds can be purchased 2 ways. First, as an individual mutual fund account, and second, as my third point, retirement accounts. There's a common misconception about retirement accounts, especially IRAs. The misconception is that an IRA refers to a specific investment with a specific fund or a specific company. That's not true. Merriam-Webster's website defines an IRA as a retirement savings account in which some income taxes on certain deposits and on all gains are deferred until withdrawals are made. In simpler terms, an IRA is just a contractual agreement between you and the government according to how you put money into the investment, how you take money out, and how it's going to be taxed while it's in there. It doesn't matter which funds you're investing in, as long as when you invest in them, you're declaring them as part of your IRA account. A lot of people will use the same mutual funds for their IRA account that they use for their individual mutual fund account. There's a lot of different kinds of retirement accounts other than IRAs, like 401ks and other employer-controlled, employer-managed investment programs. But I'm going to focus on IRAs, specifically the difference between traditional and Roth IRAs. Traditional IRAs, what sets them apart? Basically, all the money contributed in a given year to a traditional IRA is tax deductible. In essence, that's a roundabout way of being a pre-tax investment. When you properly take money out, which is called a distribution, you pay taxes on everything like it was income. A Roth IRA, on the other hand, contributions are not tax deductible. This is post-tax money that you're contributing, and distributions are not taxable if they meet all the requirements, meaning you pay no taxes on anything, the growth or the principal. Which type would you invest in? That really depends on which tax bracket you're in. If you're in a high tax bracket now, you would probably lean towards a traditional IRA. The reason being, take more of your income away from your taxable income now and pay taxes on it later when you might be in a lower tax bracket. If you're in a lower tax bracket now, you're going to want to go with a Roth. That's because you can pay your taxes now while you know you're in a lower bracket, and later you won't be paying any taxes when it's possible you might be in a higher bracket than you're in now. Both also have restrictions on distributions, the biggest restriction being that you have to be 59.5 to take money out, unless you fall under a few exemptions. Now that you've got the basics on retirement accounts, let's review everything we covered. First, I explained how to have ownership in a company or invest with them through stocks and bonds. I also explained the fundamentals of mutual funds and the advantages and disadvantages. My final point was explaining a little about retirement accounts and the differences between a traditional and a Roth IRA. I encourage you to use this information to take control of your financial future. Even if your dreams don't include a house on the beach, I feel we all owe it to ourselves to be proactive and set ourselves up in the position to have that choice. Thank you.